I'm going to show you the exact strategy I use every single day to trade less whilst also making more money than ever, just by doing the opposite of what 95% of traders do. And that's why it works. Just in this year alone, I've already made over $1 million trading this exact strategy that I'm about to show you. And this strategy has around a 77% win rate with an average risk reward of 1.97. But you're probably thinking, if the strategy works so well, why are you showing it for free? Well, first off, the strategy is pretty boring and actually takes a lot of effort to make work, but it's worked better than anything else I've ever tried over my past 6 years of trading. I know most of you watching this right now probably aren't going to do the work required to get the results you want. You've probably watched a couple other videos like this, thinking that if I can just copy the strategy, it'll be easy, it'll be effortless, but yet nothing changes. You learn more, but your results don't get better. This is because you conflate knowledge with understanding. The learning is in the doing. It is in having a journal, collecting data, and refining. What I'm about to show you is useless if you don't take action on it, if you don't use a journal to practice and find out how it works. So there's a journal in the link in the description below in the Discord server. Just join there and you'll be able to access all my information and implement this exact strategy. And the second reason is that the best way to learn is to teach. This is why I make these videos. If you want to know something, you read about it. If you want to understand something, you write about it. But if you want to master something, you teach about it. So in this training, we're first going to cover some theory behind the strategy and why it works. We'll cover some order flow and some auction market theory. We'll then go into the actual technical strategy, breaking it down step by step to give you the best understanding possible. And then we'll go through some actual trade examples that I've taken, showing you in real life market conditions, exactly how the setup can play out, and then ending it with some implementation and some action steps for you to take so you can actually get the results you want. So in order to understand the theory behind the strategy, you first need to talk about why a bearish candle starts bullish and why a bullish candle starts bearish. You see, the markets are moved by big institutions. These are the major players, and they're always trying to enter at the best possible price. They're always trying to find fair value. So if a big institution is looking to take a buy position, they will first drive down price to create panic selling and a bunch of sell volume to be able to enter and be the counterparty for those sell orders. This will create liquidity for them to enter those buy positions and then eventually drive price higher later on in the day. And so a simplified way to think about this is that in order to push bullish, we first have to push bearish. In order to push bearish, we first have to push bullish. And so you want to think about price action like an elastic band. It is a wrestle between buyers and sellers. The more you drive in a certain direction, the more likely there's going to be a pullback. As volume starts to decrease, price becomes a bit too imbalanced. Because in order to continue that bullish move, we need to collect some more energy in order to then, again, continue to drive up further. For example, for the day to be bullish, we first have to move bearish to create that daily bottom wick, to create that sell volume for the big institutions to become the counterparty of those sell orders, for them to be able to then step in and then drive price higher later on in the day. And most traders already know this. They already know how the market moves in cycles and they're trying to take these big expansive moves. But I simply do the opposite. So the core idea of this strategy is to understand how price action moves and how these big institutions participate in the market, but I do it in a different way than most traders think. I'm not trying to trade direction. I'm only looking to take temporary small reactions in price, which can occur after these big expansion areas, these big overextensions in one direction, as price needs to correct in order to push higher or reverse. But there's a high likelihood that there is going to be some type of correction. As going back to that mental model, price behaves like an elastic band. If you stretch too far, you'll then have a snap back towards balance. Price is always shifting from imbalance to balance, and it's always trying to find fair value. So instead of trying to catch these big expansive moves where you have to align 10 different things just to be able to catch one small part of that move, I just trade these little snapbacks and catch high probability reactions, not long trends. And it's designed for having that high win rate, that 77% win rate, but also having a high risk reward because it allows for a tight stop. And on average, these trades last only around 10 minutes. So I can trade less just by trading these quick snaps while still having a high win rate and a high risk reward. Because I found that the less I looked at the charts, the less I traded, the more money I made. And this strategy works consistently across sessions and different assets. It works on gold, currency pairs, and even equity. More specifically, I trade this in Asia and London session around the open of each of these sessions on gold and USD JPY. So what actually do these small reactions look like in reality? So what happens if price doesn't create that bottom wick? We don't push bearish first before that expansion. What happens if price opens and just immediately continues pushing bullish without any pullbacks at all? Well, what you tend to find is that later on in that candle, it tends to reject. This is actually a reversal signal. And for the last 6 months of my trading, I've purely been focused on waiting for this overextension and just catching these small reactions. And the name for the strategy is called a candle behavior reversal. It is a time-based, context-dependent reversal setup that exploits a predictable correction following an overextension. I mainly use it on the hourly candle, but this can be used on the daily, the weekly, as price action is fractal. So now let's go over step by step exactly how to use this strategy and find the best setups. Step 1 is just to define a middle time frame range. Okay, what do I mean by a middle time frame range? I'll be really clear on my definitions here. I define middle time frame by the past 5 to 12 hours of price action. I'm not talking about a specific time frame such as the hourly chart, 30-minute, 15. I'm talking about duration of price action, because every time frame shows the exact same thing, just in different amounts of detail. I don't think about taking 10, 15, 20 pip moves. I think about catching 10, 20, 30-minute moves. And I became profitable when I started thinking in time. And so now that we identified what the middle time frame means, how do we identify if the condition is a range? And here's a pretty simple definition here. I identify a range as whether on average over those past 5 to 12 plus hours, how much we correct the previous move. So if we have a bullish impulse here, a bullish move in price action, is it only 25%, the upper half? Is it to 50% around the midpoint? Or is it over 50% to the bottom half? And you can even go further around, over 100%, you have a breaker structure against you. And so on average, over those past 5 to 12 plus hours on the moves of market structure, how much are we correcting? But why do we want to identify a middle time frame range and condition? Well, simply because we're looking for reversals. We're looking for small reactions in price action. So we want to be trading in a condition that benefits that type of trade. If I was looking to trade continuations, or I want to be in a more trending directional condition. If I want to trade small reactions in price action, I want a condition where on average, we're just correcting back towards the mean. Most people think ranges don't have direction, but this is probably the easiest market condition to find direction. The direction is towards the midpoint of the range. And so that leads us into step 2. Now that we've identified a middle time frame range, we want to wait for a candle to overextend into the high or low of that range. And so I'll be really clear on my definitions again. I define an overextension within this middle time frame range as 20 to 30 minutes of price action moving in one direction without a pullback. And when I say pullback, I mean without a pullback towards 50%. So it could pull back around 10, 15%. I don't define that as a pullback. I define a pullback that invalidates an overextension by pulling back to around 50% or more. Again, why 20 to 30 minutes? And so I found over the years of collecting data, almost 6 years of trading, that for me, the best reversals happen around 30 minutes into the hour. From 30 to 45 minutes, after you have 20 to 30 minutes of overextension on that hourly candle, this tends to be the highest quality setup, and the data backs it up. So just to give you a quick example, I first identify that middle time frame range. I wait for an hourly candle to open within that middle time frame range here. I then wait for it to immediately push and overextend into either the high or low of that candle. So around 20 minutes of price action here. And this is step 2, waiting for this overextension, because as we previously discussed, the main direction within this condition is towards the midpoint. So the further we go into the extreme, into the high or low, the more likely it's going to reverse and pull back, especially when we're overextending without a pullback, because price tends to get exhausted. And so again, that candle behavior to open, overextend, push into the upper half of that range to overextend and correct that previous move. And this is specifically focused on hourly candles. I'm waiting for an hourly candle to open within a range for it to overextend into the high or low. And an hourly candle can be broken down into 2 30-minute candles or 4 15-minute candles. The specific time I'm looking for the overextension to occur in is around the open, and then for it to overextend and push in one direction, but just for 20 to 30 minutes. So most of the time is going to be around that 30-minute mark to around 45 minutes in. And we'll go into entries and timing a little bit later, but the highest quality trades are around 37 minutes into the hour for me. And so now that we've defined that middle time frame range, we've waited for that hourly candle to overextend into the high or low of that range without a pullback for 20 to 30 minutes. Step 3 is to wait for an entry model. And there's a couple of entry models you can use based off the type of time frame you want to enter on. I mainly look to enter on the 1-minute time frame or the 5-second time frame. But my entry models are very consistent. It's always going to be off some type of shift of market structure. And this is by far the best entry model I've ever tried in my whole 6 years of trading. It's so simple, but it works. So go into detail on exactly how to use it. So first off, if I'm trading on the 1-minute chart, I will take a 1-minute fractal shift. This is just defined by the 1-minute chart having a shift of market structure but I'm looking to enter on the pullback after that shift to around 50% of that move. And I wait for a second shift within that 1 minute shift. This allows me to avoid setups where price just immediately goes and takes out the high, but it also gives you another opportunity for a more aggressive entry. Because I've waited for the most recent structure to form, the lowest time frame to align, instead of placing my stop loss below the highest high, I can place it below this lower time frame high and enter with volume with the lowest time frame possible, avoid these losses where price just immediately goes and takes out the high, but also trading with structure. I waited for a previous high to form. My stop is protected. And that's the 1 minute fractal shift. But there's also another entry model that I take. It's just a simple 5 seconds shift. So instead of waiting for a second shift within this 1 minute shift, I will take this 5 second shift on its own. Because what you have to understand is price is truly fractal. There will always be a smaller shift here before a bigger shift that forms. And you can either wait to take the entry on that fractal shift, that shift within that shift, or you can take the entry on that formation of that bigger shift, taking that smaller shift. And so we'll go through some examples a bit later, but exactly like how I'm looking for that hourly candle to open and overextend into the range high, I can also combine it with a lower time frame candle, such as a 15-minute candle opening, immediately pushing bullish for the first half here, and then having a second structure shift when it's overextended for it to correct and snap back. This is my second type of entry model, is connecting 5-second market structure with 15-minute candle behavior or 5-minute candle behavior sometimes as well. And so as a summary, you first want to identify a middle time frame range where we're correcting over 50% of the previous move over the past 5 to 12 plus hours. You then wait for an hourly candle to open within that range for price to overextend, immediately push into the high or low for around 20 to 30 minutes of that extension. And then around 30 to 45 minutes into that hourly candle, you're waiting for a shift of market structure, either a fractal shift, 1 minute structure with 5-second structure, or it can just be a fractal shift by itself with a 15-minute candle opening, creating a top wick first, to then flip and push bearish, using the exact same concept of the hourly candle. And you're just looking to catch the small reaction in towards 50% of this range here. It's just to catch these small little snapbacks in price action. And the take profit is always going to be set at 50% of the previous higher time frame move. So if I'm taking a reversal on this bullish overextension here, my stop will be placed above the previous high, and I'll be targeting 50% of this overextension. So just for our first example here, step 1 is to identify a middle time frame range. Over the past 5 to 12 plus hours, on average, we've been correcting over 50% of the previous move. We're coming into then 50% of this previous high time frame move as well. And so what we want to do is wait for an hourly candle to open and either overextend into the lower half of this range or the upper half of this range, as this is the range created by the previous bearish impulse. So this hourly candle opens and immediately pushes bullish here into the upper half of this previous range. And we're approaching around the halfway point of the hour. We've had 20 minutes of price action moving in one direction without a pullback towards 50%. We've had that nice hourly candle overextension and waiting for that shift of market structure. What I tend to do is drop down onto either the 1 minute or the 5-second time frame, and I'll look for the exact same thing, the hourly candle overextension, just on either the 5-minute or the 15-minute candle. Immediately push bullish. We've taken out the previous high here, and we're making higher highs and higher lows on the seconds time frame. What we can do is just wait for a shift of market structure. So I look to wait for a 5-minute or 15-minute to create a top wick first, to then flip, creating that shift of market structure, taking the entry on the break of a previous low for this bearish example here. And I look to target around 50% of the extension. So we can see the 5-minute candle flip and shift bearish, taking out that low. You can potentially wait for a pullback towards 50% of that, but I just tend to enter on the breakout because these tend to be pretty high volume moves, targeting 50% of the overextension. On average, this does result in around a 1.5 risk reward. And as we can see here, takes a little while to play out, but we hit our 50% area with that correction here of this overextension. For another example, this is a bit easier. We can see over the past 12 hours of price action, it's pretty obvious that we're in a range. When does price tend to push away from the highs and lows of the range? It tends to be around the second half of the hour here, around the second half of the hour, around the second half of the hour, around the second half of the hour. Again, around the second half of the hour. Immediately pushed in one direction, opened, immediately pushed into the high, open, immediately pushed into the high, and then you have that rejection around that halfway point. And so this is the previous middle time frame bullish move here within this range. we're going to wait for an hourly candle to open here and extend into the lower half of this range. We can also, refine our entry by looking for a AOY, such as an hourly level. But this is a really nice extension here. It's already been around 30 minutes. So we'll wait for price to come into our AOY. And then around 30 minutes into the hour, we'll look for our shift. What you can also do is connect 15-minute candle behavior with that hourly candle behavior. This is the halfway point of the hour. We've had this 15-minute candle immediately push bearish. And I kind of rely on 5 and 15-minute candle behavior to time our entries very precisely. So we can see here the 15-minute candle is overextended. We have the 5-minute candle open and overextend. And so what I'll do, I'll drop down onto the seconds time frame. I'll look at the 5 and 15-minute candle behavior, wait for price to overextend against me, and then look to enter on a seconds shift of market structure where we take out a low into taking out a high. I look to align that with either a 5 or 15-minute candle with the entry on the break of this high, stop below the previous low. And so we have this 5-minute candle creating that top wick and then flipping. We have this 15-minute candle opening, overextending, pushing bearish for the first 7 minutes, 8 minutes. And then around the second half of that 15-minute candle, we're looking for the exact same behavior on the hourly candle. We've had the hourly candle open and overextend push bearish for the first half, and we're looking for the reaction towards 50% of this move in the second half. And this is how you get such good entries. You just align using the same concepts, but off different durations of price action. So we're waiting for that shift of market structure, line that with a 5-minute, 15-minute candle behavior, and this makes it really easy to time your entries. And just targeting 50% of the overextension ended up being a really nice trade. And so for our last example, we're going to go over how to enter off a 1-minute fractal shift. So first, let's break down step 1, which is identify that middle time frame range. But on average, we're correcting over 50% of the previous move. Here, relatively range bound. So we're in a nice mean reversion condition. We want to wait for price to come into either the high or low of that range. We can see that we're around the highs of this range here. And so then we wait for that hourly candle to open and it pushes bullish, continues to overextend into the high of that range. It takes a little while to overextend, but we have those 20 minutes of price pushing bullish. We can then wait for that shift of market structure. We had this 15-minute candle open, immediately push bullish, take out the previous high. It's then flipped and pushed bearish, taking out this low. So that is a 1-minute shift of market structure. What we can do is just use our fib tool, wait for price to come into 50% of this previous move and wait for a reaction at that 50% area. You don't have to use a 5 seconds time frame to take a 5-second shift of structure. Let me explain. You can look at the 1-minute candle highs and lows, and that will tell you everything you need to know about the second structure. We can see here that we've taken out this previous high. And so for that 5-second structure to shift bearish, we'd want to then take out this previous low. We can drop down onto the 5 seconds just for an example of that. We can see the high here. In order for this structure to shift, we can wait for price to break this low. And you can see this fractal shift where you've taken out this high and you've taken out this low. And then you have this high here where you've taken out this high, and then you look to take out this low. So you have that shift within that shift. So what you can do is actually put a stop order at the low of that candle. You can put your stop loss at the high of that candle. That'll be the high of that 5-second shift. And you can look to target 50% of this extension here. That result in around a 3 risk reward, 3.5. And we can see, plays out pretty nicely. Just go a little bit further, but it is what it is. We're not trying to catch big moves, just small consistent reactions in price action. And so now that we've gone through the theory, the steps, and the trade examples, if you actually want to get results now, you have to take action. Nothing changes if nothing changes. So start journaling every single trade, practice, backtest, forward test this. Get experience, because the learning is in the doing. And something that I haven't covered in this video, because I didn't want to make it too long, is correlation. Massively helps me time my entries and direction. It boosts my risk reward quite a lot. So if you want to understand exactly how I combine correlation with this approach, watch this video next. But I hope you guys enjoyed this. I hope you find value, take action, and I'll catch you guys in the next video.